Welcome to the Wiser Wealth Management Roundtable, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom are my co-hosts, Brad Lyons and Matthews Barnett. Good morning, Matthews.
How's it going?
Brad.
Hi, Casey.
So today we're talking about behavior finance. I've always been amazed just listening to people in public or that I meet in passing that don't know what I do or we do. When the markets get volatile, they tend to want to sell at the worst possible time and then buy at the worst possible time. I mean, everyone says you want to buy low, sell high, right? Isn't that the
basic premise of making money in the market?
The age-old wise advice is to buy low and sell high. But yet, data shows that we tend to do the opposite. When things get volatile, we get emotional and we start thinking about things a bit irrationally. And what tends to happen is, if we just take an example of stocks and bonds, so stocks have declined, bonds have gone up, but you're looking at that value of your stocks or the overall value, because that's what's driving the volatility in your portfolio. We tend to say, okay, I'm tired of these losses. I'm going to move to bonds where it's safer. But yet what you're actually doing is buying bonds probably near their all-time highs. And then the market rebounds and you feel better about things because the headlines maybe look a little better. You miss the rebound. You move money back into stocks. Now you're buying stocks at higher prices than what you sold them for. And then you're selling the bonds at the lower price. Technically, if you keep repeating that, eventually you're broke, right? You just keep trimming a little bit off. But yet that seems to be the mentality of a lot of individual investors.
Yeah, well, it's really based off the herd mentality, where you're kind of following what the crowd or the herd's doing. Your neighbor might pitch you something that's been working well, or you see something on TV. It's really based off just the investor emotion cycle of fear and greed, kind of the opposite of what you would think. Euphoria when everything's at the peak. It's actually the maximum risk, but it's unfortunately when everybody's getting into the market. And then at the bottom, during the capitulation and bottoming of the phase, is actually the maximum opportunity. So it's when people should be getting in the market. So there's a whole phase of emotional cycles that go into investing. Unfortunately, sometimes it's easier just to follow the crowd and do what everybody else is doing.
And it's really unfortunate that this does occur. And it happens quite often in older investors, where that investment portfolio is about to become or has already become a major source of income to them. Even in low inflation that we're experiencing now, the only asset class that is going to provide the opportunity for growth beyond inflation is equities. So it's going to be difficult for them to ever catch up relative to inflation if they sell at the very worst time and then miss the upturn in the marketplace.
I think that's part of loss aversion too, which is a big term with behavioral finance, which is that people place greater weight on losses than the pleasure of gain. So during those times, they're really more focused on getting away from the losses more than having some gains in their portfolio.
That is such a true point. In fact, it was a basis for a Nobel Prize winning economist, Daniel Kahneman, who created what was called the prospect theory. And from that, he determined that the loss aversion is so great that people feel twice as bad about a dollar that's lost than they do good about a dollar that's gained. So the loss aversion is somewhere in the neighborhood of 2 to 1 for people, which makes it difficult for them to make decisions sometimes because they're so concerned about losing that money in the marketplace in this case. So in 2002, the Nobel Prize Committee recognized this gentleman who created this theory and awarded the Nobel Prize, and has become a basis for investing and investment sentiment since then.
We obviously know another big driver in investor behavior is the financial news media too. If you think about the news is a business. They're there to make money. And they make money by having more people glued to the screen or buying the subscription to the newspaper or to a magazine. And to draw people generally aren't drawn to the good news. They're drawn to mayhem, right?
It's clickbait.
Exactly. So I see that even in just the TV monitors we have here in the office. Market's down maybe 0.5%, but the market had a massive sell-off today, or investors fled stocks today, or just very sensational type headlines. And we watch that and we listen to people talking about the moment. So the people on the news media are saying this is what's happening in this particular moment, but that's not your particular moment, right? You should be focused much longer than a trading day. And so we have people who are paid to say that they're selling. And I've known a lot of people over the years that have been on CNBC, Fox Business News. And what's interesting, they talk about individual stocks, yet with their clients and themselves, they're buying index funds just like we do. Yet that's not what's fun to talk about on TV. We want to talk about the individual securities, right?
Right.
And then the other part too is our peers, listening to our peers. So you're standing over the water cooler and Bill decided to take all his money to cash. And Bill's probably a smart guy in what he does. And so well, man, Bill's a smart guy, so I better sell mine too. So you run back to the cubicle and sell the portfolio to cash.
Which is probably why people underperform the indexes as well.
Absolutely. Absolutely. Isn't that called the behavior gap?
Yeah.
I think that research has shown that the average investor only earns 1% or 2% on their portfolios over long periods of time, given the fact that they're getting in and out of the market based on this news. We know that as investors, if we miss the top 10, for example, best days in the marketplace over a period of time, we're going to lose over half of our potential gain. The key is just to be in the market, have a plan, and be in the market through these ups and downs. And if you're putting new money to work, dollar cost averaging it in is a great way to enter the marketplace.
Right. We've talked about that before. It's tough to time the market, but getting out and getting back in, and it's actually requiring you to time it perfectly twice, which isn't going to happen. So that's a lot of times you're getting in at the worst time after you missed all those gains. So it's tough to time.
Another bias would be hindsight bias, right? Where you're always looking in the past. So you look at these charts, it's like, well, I knew I should have gotten out here, and I kind of felt like I should have gotten back in here. And you're looking at all these confirmations of the past, which do not.
Shoulda, coulda, woulda.
Yeah, exactly. Exactly. When really you're just better off riding all the way through it. As a firm, and during the financial crisis, we managed to get everyone to ride all the way through 07, 8, and 9. And people were better off because of it. But in 2011, I started meeting people who had $1 million. But they had $500,000 because they liquidated in March of 09, the low point, but never put any money back in because they were too fearful of that loss aversion that we just talked about.
I think you can go to the other side of that as well and be overconfident, kind of like in the 2000s where all the hot .com stocks and tech stocks, everybody was fleeing to those. It's easy to speculate and get confident when those stocks are doing so well, or even to trade a bunch. But a lot of times it puts you in a bad situation where you're not diversified in portfolio. You might just have a bunch of speculative individual stocks. And that's not really a managed portfolio that really has an end goal to help you out.
Very true. Very true. Another one too is what we call anchoring.
Yeah, where you're where you're relying too heavily on a piece of past information. It can be like the stock price of your recent portfolio. You kind of focus in on that, and kind of that's your relevant point of information moving forward.
And the problem with anchoring bias is that, especially in investing in the markets, by their very nature, are constantly changing. Information changes, companies' revenues are being reported, investor sentiment changes all the time. So using anchoring is like driving your car by looking in the rearview mirror where you've been. And that's a recipe for disaster, I tell you what.
What I find interesting is several studies have shown that 70% of investors have no financial plan. Just think about in a business environment, like you're running a company and you have no business plan in place. You're here today to make or sell widgets, and there's no marketing strategy. There's no employee strategy. So we're just going to put money in and we want it to grow. That's our plan. That's not quite good enough. You can have a simple plan. Sometimes we have clients with simple plans. It's get out of debt, right? Build up an emergency reserve, then invest. If you want to break that down, I guess you think about cash flow. So if you're retired, we want to make sure that you have 2 years worth of cash flow available that's outside the market. Your spending rate obviously has a lot to do with that. And then how much volatility you're willing to take. if a person could be 100% stock because they're young, they have a 30-year time horizon, but if they saw a 20% decline in their return, then maybe that's not the right allocation for them. You have to pick the right allocation between stocks and bonds to make sure that you can have the best behavior and that you're not going to liquidate out of fear or any of these biases that we've already talked about.
I think we're able to do that a lot of times through just different types of risk questionnaires and then understanding, like you said, not just what that portfolio can grow to, but how that incorporates into your financial plan, kind of what are the point of those assets, not just what can you grow it to. I mean, you need to know what the point and then how much you can stomach in a downturn. You don't want it doesn't matter how well it's performing if they're going to get out of the market at the worst time.
Absolutely.
Well, the financial plan should drive the investment portfolio. That provides the objective for the portfolio. Otherwise, just buying a stock here or there, or buying an ETF or buying a mutual fund and hoping it does well, not really recognizing what you're going to do with that in the future. So the financial plan, as you mentioned, Casey, is like a business plan, or even simpler, it's like having a roadmap when you're going on a trip.
Right. Well, I was even more surprised to see professionals such as ourselves and their practices. Only 47% of advisors had a plan for their client with assets below $1 million. If they're managing assets between 1 and 5 million, it increased to 65% have a plan. $5 million or more in money managed, only 69% had a plan. To me, that's shocking that you could invest someone's money with no roadmap and have no understanding of what the long-term purpose was. That's really amazing. Even just a simple one pager, this is no plan in place.
Well, it used to be about investment. Like we just said, it's more investment management. Now it's kind of financial planning. What are the point of the assets? How do we reach these goals? It's not strictly portfolio management. So a lot of the business now is just focused on the plan.
Right. And I think that for independent, fee-only registered investment advisors like ourselves, fiduciaries, the plan part seems pretty common in firms like ours. But our firms don't manage the majority of assets. It's large institutions, and they're more transaction driven. It's how much money can they make on that transaction, and planning becomes a drag at that point. So it's kind of transitioning back to individuals and looking at maybe a few questions you can ask. What circumstances should we expect that we would make a change in a portfolio?
I guess one of the primary circumstances that would cause us to change a person's portfolio would be that something in their plan has changed. Something in their lifestyle has changed, and they want their plan to accommodate that change. And once the plan changes, if that should be the case, then the investment portfolio would have to change to accommodate that as well.
I kind of see it as maybe a birth of a child, marriage, divorce. All those things would be valid reasons to start making changes. Possibly retirement, although I feel like that you're transitioning prior to retirement.
Yeah, if that's a new event in your life, right. You hadn't already planned for it.
Maybe a forced retirement. I mean, we've seen that true. Before, where it was a surprise retired 4 years sooner, and then we go ahead and have to transition into portfolio that a little sooner than what we had expected.
But we planned for the drops, so that shouldn't be a concern. I mean, it's those major life events that would change the plan. But
that's kind of the whole point. Market news and market events are not reasons to change portfolios.
No.
What are we supposed to do? What's our recommendation to clients when we have coronavirus, when we have financial insolvency of companies like we did in the great financial crisis? We tell them to stay the course, right? And sometimes that's hard to do that. I think as a firm, we tend to over-communicate at times, which is probably a good thing. We start podcasts to talk about it, right?
To outreach. I mean, I think it's you're counseling more than sometimes than you're advising or managing assets. It's about really reaching them, understanding what's important.
Yeah, absolutely. You want to build a portfolio to weather any storm, really. But what's interesting in these last few events that we've had in 2020, you go back and you look at the plan. Well, the plan already took into account up to 20% loss in a year, right? The next year it took into account usually a single digit, 6-7% loss. And then it assumed you only return maybe 4.5 to 5% in retirement going forward. The plan's already simulated this market volatility. And that's something we could probably talk about more during the financial planning process, but then remind people when we go through times like this that all this has already been decided. It's already been modeled.
And by it modeling early in the plan, that's the worst case scenario for the plan. So by showing it up front and then having a normal return stream thereafter and still being able to achieve all the objectives of the financial plan for the person, we've considered what would be the worst case scenario, rather than considering, well, what happens in 10 years if we have a market drop? That's not the worst case scenario. The worst case scenario is that it happens early on in the investment process.
Absolutely. Another question I think we get is rebalancing. And we talk about that. Well, hey, the market's down. Maybe we should rebalance. I think we had one or two comments about that. In our own newsletter, we said we have a planned rebalance. But that rebalance is not triggered directly because of market news. It's really triggered because certain asset classes become too high or low valued. It's 5%. So we have 30% allocated to the S&P 500 and it drops below 25 or goes above 35, that triggers a rebalance.
But I think people think that rebalance meant getting out of equities and moving to bonds. It was actually the opposite of that. We were a lot of times buying the undervalued stocks and taking away from the bonds. I think we get that question a lot. What do you do during these times? And I think a lot of times that mean they picture you being defensive and moving out of the market is what the planning is.
Well, it's interesting the way you put it, because we're buying the undervalued securities by selling the overvalued securities. And it's just the way we started out this podcast, is saying that is the definition of successful investing, which is buying low and selling high. When we rebalance, we're forcing ourselves to make changes in the portfolio where we're selling those asset classes that have risen in value and buying those asset classes that have become undervalued, and thereby buying them lower and hoping we get a greater return in the future.
The same way for dividends. We've done the research on this. There's a lot of people just reinvest the dividends back into the fund that paid the dividend. What we like to do is let the dividends go to cash, and then you reinvest the dividends into the underperforming security, to the underperforming index over the last basically week, because you do this on a weekly basis. And it actually adds a small amount of rate of return to the portfolio because you're always buying the lowest performing asset class, right? And assuming that you have, and we do, long-term healthy asset classes built into the portfolio, it's all going to come back up eventually. And at some point during a rebalance, you're selling those shares off for the gain and then buying other asset classes that have underperformed, such as bonds or high yield bonds or real estate, or what have you, inside a portfolio. Again, that is part of a plan, of an asset management plan. There's no emotion involved in that. There's no sitting there go, well, how do I feel about this? And that anytime you sit down and go, how do I feel when it comes to executing a plan, you're wrong. You have to just go execute the plan almost in a mechanical manner, because when you're watching 1,500 point down days, you're going to have a lot of feelings and a lot of emotion about that. But we know that if we execute this in a certain order, that we're going to be just fine, right?
You mentioned a Vanguard study earlier, and that was based off the Vanguard Advisor Alpha study, where that advisors actually provided over 3% of value to clients. And about half of that was based on behavioral finance. So it wasn't just about the numbers and the management. It was about kind of the counseling and coaching that led them through that process.
Yeah, absolutely. Absolutely. A lot of people, it's kind of a smart answer, but they'll say, why should we hire you? Or why should we hire any advisor? And generally the answer is, we'll protect you from you, right?
Right.
To be here as your guide to say, yeah, that's probably not the best decision. Maybe try this.
And they're starting to teach it more as well, because the CFP board, the CFA Institute, and the Investment and Wealth Institute are now having a portion of their tests on behavioral finance. So it's starting to become, it became more popular the last 10, 15 years, but it's really becoming kind of the future focus is how to help our clients and investors manage their behaviors.
I remember, I don't know if Robert Shiller was one of the first ones to teach behavioral finance or not, but on your iPhone, I don't know if it's still there. They used to have iTunes U. So it's iTunes University, and you could download different classes. I downloaded his class on behavioral finance. I watched as he talked. It was rough video. This is in the early days, I guess, of all this. But basically, his whole thing was, well, the value of the stock market is the present value of future cash flows or growth of a company, right? And so if you do that, you have this really smooth line going from left to right, increasing. Over time, the stocks will be increasing, but that's not what actually happens.
That's not what happened. And his analysis of asset prices won him a Nobel Prize in economics, challenging the efficient market hypothesis that, as you described, Casey, it should be a smooth increase in values over a long period of time based upon increasing cash flows from companies paying out dividends to investors. But Robert Shiller found that the range of returns were beyond what could be described in a normal market occurrence of cash flows being discounted back to the present time. And the only explanation that we could come up with, or he could come up with, was that there are irrational decision makers participating in the marketplace. And that irrationality is investor bias, several of the ones that we talked about. What we do by having a plan, and what other registered investment advisors who are fiduciaries should be doing, is saying, here's our plan. And we're going to take emotion and bias out of the decision making and have a plan towards accomplishing the goal, first by having a financial plan, helping clients clarify their objectives, showing that how they can be accomplished through this portfolio management, and then having a plan to the portfolio management itself. In one instance, as you talked about, reinvesting dividends into the whatever is the lowest valued asset class at the time, thereby taking out the emotion. Well, what do I think is a good idea for investing right now, for example?
William Bernstein said in the short term, the stock market's a voting machine. In the long term, it's a weighing machine. And it's always one of my favorite quotes.
You're invested for the long term. The short term events are scary, but they shouldn't mess with your portfolio.
It's the healthy companies that survive in the end, which it goes back to our philosophy of investing in just core asset classes and staying away from the fringes of risk, where you can have great returns, but also great losses. In the end, there's lots of academic studies showing that 99% of active fund managers don't even beat the index over a 20-year period. And one of the things we talk about is when we manage assets, we want to teach it or manage it like an endowment. So how long does an endowment have to last for an institution? Forever.
Exactly.
Forever, right?
Yeah.
With individuals, we're probably not going to live forever, but when do we check out? We don't know that. So let's just assume age 95, unless you have proof in your family otherwise. So we're managing assets to age 95. That our objective, our simple objective, is to get you from today to age 95 without running out of money. And one of the ways you can run out of money is being a trader and not an investor. You keep thinking, oh, well, this is the worst crisis ever. I have to get the cash. And then you flip it back around and you buy at the wrong time, where if you're an investor, you're there for the long haul.
Well, I make the distinction between investing and speculating. So traders, in my opinion, are really speculators. I think I'll buy this today. Hopefully it'll go up. Then I'll get out tomorrow. It all sounds great in theory, but it's just very difficult to do.
Do you think there's a way that investors, not advisors, but investors, could find a way to control their behaviors more? I've seen that it helps to recognize it, but that doesn't mean you're actually going to live by it. I've seen a few things. It's kind of cheesy, but it was talking about having a journal, about journaling how you felt 2008, and just go back to that and remember how you were feeling and how things worked out. But you don't necessarily have to have a journal. But I think, is there a way that they could learn their behaviors?
I think it's just having a system in place. Our clients know that we're here and we're monitoring all this. And what happens is they don't look. So maybe that's a thing that you can deploy personally, is say, okay, well, I'm going to set this plan. I'm going to set this allocation, and then I'm going to take a look twice a year to see where I am versus my goal. Right. For some people who have been over allocated, they have too much risk and now they realize this. Oh, I'm not comfortable with this amount of volatility at all. You don't want to go to all cash. Maybe the process could be, I'm going to sell 10% of my stocks and move it to bonds. Well, it's probably not the best time to do that. I mean, I'm not necessarily talking about today is best time, but maybe in your situation, it's not the best time. But you took action and you did something. I have a background in aviation, and when we were learning, they call them V1 cuts. So V1, that's the speed at which you can't stop on the runway anymore. So the instructor would cut the engine off right at V1. You start rotating and coming up, and next you look down and there's an engine that's failing, right? And you want to take action. You want to take action right away, but really it's all designed that the engine can just fall off the airplane. You don't have to take action. There's steps that you go through. It's creating those own steps for you, like a checklist, to make sure that you do the right thing. You don't shut down the good engine while reaching for the bad engine, right? You don't have a double engine failure right at takeoff. You can't recover from that. And that's what we're doing with our portfolios, where when we liquidate, we're cutting off all the power, going, I can't take this anymore. I can't take dealing with these faults or this volatility. So coming up with ways to transition back would be much more helpful.
I like what you said about the checklist, which I think, Matthews, to your point, can people change? And can they recognize their bias towards investing?
Right, so it doesn't happen again, because it's going to keep happening.
I think it would be very difficult unless you mentioned a journal, Casey mentioned a checklist, unless you had something there to remind you of past circumstances. It's not always so easy to do that, I don't think. I think that the best way to recognize that we have bias is to find somebody who can guide us through our bias and get past that in order so that we can be successful and go about the rest of our lives. Casey mentioned that many of our clients have relied on us to do this for them. And they go on about the rest of their lives and behave normally throughout the given days and not watch the news every day because of this sensationalism, because the news is there to make money through advertising dollars. If they can't sell their airtime to advertisers, they can't make money. And if there isn't people sitting there watching the news, hanging on the next word that they're going to say, they can't get advertisers. So it's a business.
It's the same way with the guy on my Facebook feed right now that keeps popping up that he retired at only 30 years old, and you can buy his process on how to do this through investing. And I thought, well, if he really retired at 30 years old, why is he trying to sell me a process to be retired? To be retired early? How is he retired if he's selling me stuff? He's working. Right. He just did a different job. I think to kind of summarize this, or I guess another point I'll make before we summarize this, is that you have to set goals, and your goals should not be to beat the market. That's not a realistic goal. Most people don't, or it's very arbitrary. It really needs to be more specific. Like, I want to have X amount of dollars in retirement, and I'm trying to save to X amount in my portfolio to generate so much in growth and earnings going forward. That's a better goal, right?
The highest probability of success in your plan to reach those goals, not the highest return of your portfolio.
Correct. Yes. And using reasonable returns, not, well, if I can get 8% or 10%, markets aren't that linear. So we have to account for market volatility, which even a lot of advisors aren't doing that.
Well, that's exactly the way large institutions manage money. But pension managers or endowment managers, as you mentioned earlier, they have a goal. The pensioners is to pay out those benefits to people who are receiving them as income in retirement. For endowments, to pay out money towards a cause, be it scholarships for students or hospital equipment or some other cause. But it's a required rate of return that they need to match. They're not trying to maximize the return in the portfolio in any given year. Happy to get it
right
in those years, and we are too. But to have a goal that you're trying to reach that is reasonable and assumable.
What's interesting is a lot of people will come in at the beginning of retirement and say, here's my assets. Now I can double my money every 7 years, right? And that's really the wrong way to look at it. It's really managing your lifestyle. Like, why would you take additional risk in your portfolio if you're comfortable living the way you are now? So really it's aligning risk and return to achieve your retirement goals. That's really what it comes down to. In the Vanguard study, there was a quote of, what's the use in running if you're not sure you're on the right road, right? And that's where I think planning helps behavior, that there's a plan in place, you're going to execute that plan, and you can try to stay away from herd mentality and loss aversion and a confirmation bias and angering, overconfidence, all the things that we talked about today. And if you do that, the Vanguard study shows that you'll have an average 3% higher rate of return per year.
Now, as a single digit, 3% doesn't sound like much, but you compound 3% over a lifespan.
Absolutely.
Significant.
Huge.
Absolutely.
Yeah.
Absolutely. Well, guys, enjoyed the conversation today.
Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.